Welcome to my wallet size. Today's episode is all about the consumer electronics giant, Apple, ticker symbol Apple. It is considered as the most valuable company in the world with market capitalization of $2.7 trillion. It is America's success story many times over. With the recent earnings report for the second quarter ending March 2023, we would like to determine if Apple has outperformed, and figure if the stock is a buy or sell. Let's start with financial metrics. In the second quarter of the year, profitability underperformed with a huge drop in revenues by 19% quarter-over-quarter to $94.8 billion. Year-on-year, revenues fell by 2.5%. The decline in revenues can be attributed to the slowdown in sales of wearables by 35%, iPad by 29%, iPhone by 22%, and Mac by 7%. Services managed to eke out growth by a minuscule 0.68%. Year-on-year, iPhone grew by a measly 1.5%. Except for services, all the other products registered a drop in revenues year-on-year because of persistent inflation that plagued the economies of the world, thereby reducing the consumer's power to spend on luxury. By reportable segment, demand for Apple's products declined significantly in China by a hefty 25%, followed by the Americas by 23%, Asia Pacific by 15%, and Europe by 13% for the second quarter of 2023. It is only Japan that saw an increase in demand by 6% during the quarter under review. On a year-on-year basis, Asia Pacific showed signs of growth in demand by 15% because of the emerging market's favorable response to Apple's high-end products. On the liquidity front, Apple's liquid assets, composed of cash and marketable securities, have reached $56 billion as of the end of the second quarter. These cash reserves are not even sufficient to cover short-term debts amounting to $120 billion, let alone the long-term debt amounting to $97 billion. Days inventory hit a high of 102 days as of end second quarter 2023, where inventories reached $7.5 billion versus $5.0 billion a quarter ago. These days inventory is the highest compared to the previous 3 quarters, indicating slow inventory movement because of weak demand. About solvency, Apple's debt-to-equity ratio is considered very high at 86.5% as of end second quarter of 2023, compared to Microsoft of 24.8%, Alphabet of 4.5%, and Meta of 8.0%. The high leveraged position of Apple can be attributed to huge borrowings to finance its regular dividends and stock buyback program. Putting it all together, Apple's financial performance for the second quarter of 2023 may be considered underwhelming based on the metrics just mentioned. What the bulls say about Apple. 1. The company is still innovating with the introduction of Apple Pay, Apple Watch, and Apple TV among others. Just recently, it launched its Apple Card savings account in partnership with Goldman Sachs, where it generated a total deposit of $990 million with 4.15% annual percentage yield for such a short span of time. 2. Apple has a loyal base of customers willing to buy its various products and services. It has an installed base of more than 2 billion devices in use today, where it could drive incremental revenues for its other products and services. 3. Based on Apple's hardware, software, and services, the company has made it difficult for existing customers to switch to other providers because of the cost involved, and network effects associated with its iOS ecosystem. 4. Apple is now penetrating emerging markets, particularly India, due to its population and increasing middle class who can readily afford its high-end products. 5. It is continuously buying back its shares to improve the price of its stocks. It has recently announced its intention to repurchase its shares to the tune of $90 billion. What the bears say about Apple. 1. Apple is maintaining a premium pricing strategy to maintain gross profit margins and retain its image as a high-end provider of products and services. However, by doing so, it could crimp growth in revenues and earnings as well. 2. Existing customers are holding their iPhone for longer as they don't see an urgent need to switch to an updated one, as their existing phones are still functional for their own use. Another reason is mainly economic, where inflation has whittled their power to buy new electronic gadgets. 3. Apple is highly leveraged compared to peers. It is dependent on loans to finance its dividend distribution and stock repurchase program. 4. Its cash reserves have dwindled to the point that it is not enough to cover short-term liabilities, let alone the long-term loans. 5. Apple's service revenue could be dramatically impacted if the antitrust ruling goes against it. It is accused of monopolizing its App Store to the detriment of fair competition. Chart indications. Apple is forming a flag pattern from 2019 to the present. A flag pattern is a short-term continuation pattern that marks a small consolidation before the previous move is regained. The pattern is formed when the market consolidates in a narrow range after a sharp move. Currently, Apple's stock range is between the support of $130 per share to the resistance of $173 per share. Currently, the market is resisting any price higher than $173, which is respecting the range of the flag pattern. For a stock in an uptrend, a breakout from $173 is typically a strong bullish indication. Stock prices are over the 50-day and 200-day simple moving average, implying a bullish indicator. RSI is at 61.69, indicating that the stock price is not yet overbought and still has room to move up. MACD is bullish, where the MACD line is now currently above the signal line. Valuation. Based on PE multiple, Apple shares are now trading at 28.9x, cheaper than their peers of 29.6x, but expensive compared to the industry of only 16.2x. Analysts estimate that the fair value of the stock is between a low of $120 to a high of $150. With the current price of $173, the stock is considered overvalued. Analyst growth forecast. Based on analyst growth forecasts, Apple is projected to register an annual revenue growth of 6.5% and annual earnings growth of 6.7%. This is way below the analyst forecast for its peers. The projected annual revenue for Microsoft, Alphabet, and Meta are 11.0%, 9.6%, and 9.2%, respectively. On the other hand, the forecasted annual earnings growth for Microsoft, Alphabet, and Meta are 13.5%, 13.0%, and 14.3%, respectively. With these weak projections, Apple cannot be considered as a growth stock anymore. The next question is, what the next big growth driver will be for Apple stocks? Is the stock a buy? The stock is up by 37% year to date, and 6% below its all-time high in January 2022. Of the 25 analysts covering Apple, 88% recommend a buy while 12% recommending a hold. Meanwhile, we think Apple is not a buy right now because of the following considerations. Underwhelming second quarter performance. Stock is considered overvalued. Marginal growth forecast for 2023 both in revenues and earnings. Investors are resisting a stock price higher than $173 and may fall further, and it has not established a clear buy point. On the economic front, the debt ceiling is not resolved as of yet, and the uncertainty surrounding the path of Fed and its interest rate policy. We want to emphasize that we are not financial advisors, and should investors decide to purchase Apple shares of stocks, one should conduct his own due diligence or consult at least his own financial advisor. If you find this useful, please hit the subscribe and like buttons. Thank you for listening and see you on the next video.